If your agency employs developers who build custom tools, proprietary render pipelines, or automation that did not previously exist, your agency may be leaving up to £80,000 a year on the table with HMRC. Not because of the creative work, because of the technical work that sits underneath it. In the next 7 minutes, I am going to show you the clear line HMRC draws between creative production and qualifying R&D, and which side of that line your agency's technical work sits on. By the end of this video, you will know exactly what HMRC looks for when assessing a creative agency's R&D claim. You will know which technical activities qualify and which clearly do not. And you will know what the recovery looks like for an agency at your scale. No creative industry jargon, just 7 minutes. This video features an AI-generated presenter. All content is for educational purposes only and does not constitute tax or financial advice. Always consult a regulated specialist for your specific circumstances. First, a clarification. This video is specifically about the R&D tax credit for the technical development work that agencies do. It is not about the audiovisual expenditure credit or the video games expenditure credit. Those are separate reliefs for TV production and game studios. If you are a video production business or a TV broadcaster, those other schemes may be relevant to you, but they are a different topic. What this video covers is the R&D tax credit for the technical engineering work that often sits inside agency operations. The information and communications sector, which covers many creative and technology agencies, accounts for 26% of all UK R&D claims. Agencies with in-house developers are often in this bucket, but most agency founders have never asked the question because they assume creative work does not qualify. The honest answer is, creative work does not qualify. Technical development work often does, and many agencies do both. HMRC's definition of qualifying R&D requires work that seeks an advance in science or technology and resolves genuine technical uncertainty in achieving that advance. Notice what is not in that definition. It does not say the work has to be scientific in the traditional sense. It says science or technology. For an agency, that means the question is not, is this creative? It is, does this involve genuine technical uncertainty in the software or systems layer? HMRC explicitly excludes advances in the arts, humanities, and social sciences. So the creative concept, the narrative, the visual direction, those do not qualify. But the custom tooling that the developers built to make those creative ideas work at scale, that is worth asking about. Let me be specific. Activities that may qualify in a video or creative agency. Building a custom real-time render pipeline because commercial render engines could not meet the frame rate or resolution targets your client required. Developing a proprietary motion capture processing system that existing tools could not handle at the volume or accuracy your team needed. Creating an automation layer for asset management and delivery that no available software could do without significant custom development. Writing custom software for interactive installations where the technical constraints, latency, sensor integration, and scale required novel solutions. What does not qualify? Using existing tools in the way they were designed to be used, even if the output is impressive. Post-production work using standard industry software. Design and art direction, regardless of how technically demanding the brief. Project management of technical teams. Here is a worked example. An agency with 3 full-time developers, each costing £75,000 all in, including national insurance and pension. If 70% of their time goes to technically qualifying projects, that is £157,500 of qualifying staff cost. Add cloud render costs and software licenses directly used on those projects. The qualifying expenditure is now potentially £170,000 or more. Under the merge scheme at 15 pence per pound, that is approximately £25,500 back from HMRC. If the agency is loss-making with R&D intensity above 30%, the ERIS rate of 27% means a cash payment of roughly £46,000. The most common mistake agency finance directors make is only looking at projects explicitly labelled as technical or development work. But qualifying R&D can sit inside production workflows. Inside internal tooling, inside the custom integrations your team built between systems. A specialist assessment looks at all of it, not just the obvious development projects. So, to bring this together, creative work does not qualify for R&D tax credits. Technical development work that resolves genuine uncertainty often does. If your agency employs developers building custom tools, pipelines, or systems that did not previously exist, that work is worth assessing. The qualifying costs include developer salaries, cloud and compute costs from April 2023, and subcontractor development work at 65%. And the 2-year filing window means that if your developers have been doing this for years and you have not claimed, the most recent 2 periods may still be open. If anything in this video resonated with your situation, the next step is straightforward. There is a free, no-obligation specialist assessment linked in the description below. It takes 5 minutes to complete. The regulated specialists I work with operate on a no-win, no-fee basis. If your agency does not qualify, there is nothing to pay and nothing to lose. The link is uplifttax.com/partners/E5J3P6. It is also pinned in the comments. If you found this useful, the video on qualifying expenditure, which cost categories count, and how to calculate them is worth watching next. It is on screen now. I will see you in the next one.